Good morning and welcome to the Newgate Wealth and Asset Management Seminar. Is the asset management industry a leader or a laggard in the ESG revolution? And I'd like to extend a particularly warm welcome to our fantastic panel of guests today who bring their unique but complementary insights on today's debate about what is very much a hot topic at the moment, the issue of ESG, sustainable investment, climate change, COP26. These are all issues which are very much on the news agenda. James Leaton is Vice President, Senior Credit Officer in Moody's Global Environmental, Social and Governance team and leads the development of carbon transition analysis of companies in high impact sectors. Martina Macpherson is Head of ESG Strategy for ODDO, BHF Asset Management and Private Equity. Martina is also part of the Global ESG Leaders Forum and the European Law Institute's Finance Advisory Committee. Lauren Mason is editor of Investment Week, the UK's premier investment title aimed at professional investors and wealth managers. And Harald Walkate is head of corporate social responsibility and ESG at Natixis. Harald has over a decade's experience at leading companies such as Aegon and is an expert on blended finance. And I welcome very much our panel today. We have a very interesting debate. We're going to have a chat for around about 45 minutes around a lot of the key issues, and then we're going to put the floor open to questions to everyone. If you do have any questions in the meantime, please feel free to send them via the chat facility. You can just type into the chat and we'll look at those questions. Harald, let me start with you. As I mentioned, COP26, new regulation, the focus on Build Back Better after COVID-19. Is this the year that ESG finally becomes truly mainstream?
Great question. I mean, I hope so. I think so, but it does depend a little bit on what you mean by ESG becoming mainstream. I think it's hard to claim that it's not mainstream if you see how much people are talking about it. All of the major newspapers are talking about it. All of the large asset management firms are talking about it. So I think we might even be able to argue that it's already gone mainstream. I think what's hopefully happening this year is, I think, more of a debate about which of these things that we're doing under the header of ESG are actually working, in the sense that they are doing what we hope them to do. Because I think there is quite a lot sort of in the world of ESG that that sounds good. We started out 10, 15 years ago, and I think if you look at some of the academic evidence that is coming out, not all of it is actually doing what we expected it to do. And so that's part of ESG I hope is going to become mainstream this year, sort of more of a debate, a little bit more pragmatic and evidence-based about all of these practices, and also how we should pivot going forward, always asking the question, are we actually making a difference? And if not, what should we do? Who should we work with to make more of a difference?
Well, I think there's some very interesting points that you raised then, and I think that I'd like to bring Lauren in at this moment in time, because our investors and action groups realistic about what asset managers can actually deliver. I mean, it seems that every single week there's some sort of report that comes out that criticizes, particularly the very large asset managers and how they're performing in ESG terms. Are people being realistic? Is it really up to asset managers to deliver these impacts, or is it something where we require the input of government and other people to do that? Lauren, I don't know if you've got any thoughts on that.
Sure. I think asset management, the asset management industry certainly has a responsibility in terms of encouraging sustainable investing and ESG investing. I do also think that it's down to the end investor as well to get under the bonnet of each individual product that they're investing in. Because after all, I know that for as much quant-based screening as we have in ESG ratings, ESG and sustainable investing is still very much subjective. So it's very important to hold asset managers to account and really get under the bonnet of the portfolios. But also, it's important to note that people have different styles of investing. It's no longer simply ESG. You know, SRI, impact, ESG, they're all very, very different kettles of fish. And it's down to the end investor to choose the right product for them. And because it is subjective and because it's such a fast growing area of the market, the infrastructure isn't yet in place to make it clear cut in terms of making investment decisions. So it's the onus certainly falls with the asset management industry to ensure that they're investing responsibly, but also the end investor needs to be responsible for their own decisions and researching the products before they choose to invest in them.
Well, I think now would be a very good time to bring James in on this, because James works for Moody's. Moody's obviously applies certain criteria to measuring aspects such as ESG. And you mentioned about the subjectivity. I mean, James, is there a move towards standardization in the industry, towards having a very set way of looking at how we measure ESG factors and criteria? And if so, how's that going to formulate itself? How's that going to look going forwards? Yeah,
I mean, I think, there's obviously regulated parts of the system and unregulated at the moment. What we do within the credit ratings agency is very regulated, and that's been established for some time. I think, as Harald said, it's about what do you want this tool to do for you? What do you want this data to tell you? What is the purpose you're trying to apply it to? Are you trying to calculate the impact of your fund? Are you trying to seek, alpha and differentiate in terms of what you're investing in? Are you trying to ensure compliance across, a range of policies and standards in your portfolio? Are you trying to identify best in class? And, that could be on ESG, it could be on a number of things. So I think that's where, at the moment, to me, I'm not so concerned about we need one standard. It's more about understanding what the different tools do and applying them in the right way. That's when it becomes dangerous, if you're using the wrong tool for the wrong job. And I think that's where, at the moment, not everyone's clear on what they're trying to do. There's the danger of it becoming mainstream, although it's probably becoming mainstream for the last 10 years, is that then, as we see, it's become mainstream in the marketing department. So therefore, we've got the greenwashing concern, as Lauren said, that we need to address as well. So for me, it's, horses for courses is the main thing, and being clear on what you're trying to achieve.
Martina, if I can bring you in here, because obviously you have quite an interesting background. You've worked for MSCI in creating indices, which will look at factors in S&P and Moody's also. So I don't know what your thoughts are around that sort of standardization piece. And I think when we chatted previously, you mentioned that across a lot of the various providers of criteria, there's around about a 60% correlation, whilst you get a much higher correlation, for example, between the credit rating agencies at that more formal end of things. So I'd just be interested to hear your viewpoints on that.
Yeah, very much so, Charles. I can say I've covered the investment value chain, definitely buy side and sell side. And I think what is something that has changed over time, and we touched on this, is that we now see a pluralism of different type of ESG approaches and strategies being applied. Now I'm talking about the investment management industry. And when we do that, we look at screening, we look at integration, we do our active ownership / engagement and stewardship approach at ODDO BHF. But more generally, for the industry, some of the key challenges prevail when and where ESG data, disclosures, definitions, and ultimately standards come into play. And you highlighted some of the studies that have been undertaken in the field of ESG, comparing ESG ratings, for instance, with credit ratings. The MIT Sloan study of 2019, very much called the aggregate confusion piece, is highlighting that ESG ratings on average are just correlated at around 61%, while credit ratings, and James here on board as well, is obvious they are correlated at a level of 99%. And that has raised a couple of questions in the industry, now seeing this value chain from both sides. In the industry, when and where also now disclosure practices are concerned. As you know, SFDR regulation has come into play on the 10th of March. We all have been working towards this to get within the fund management industry, the investment products and vehicles compliance or in compliance with the new regulation, level 1 disclosures. That's around pre-contractual information. But now when we're moving towards RTS, regulatory technical standards, so to say level 2 disclosures, by the end of this year into next year, we are much more, as an investment management industry, encouraged and mandated to disclose the type of ESG information we have with our investment portfolios, but even a step further, also the level of benchmarks and the type of benchmarks we're using. And especially Article 9 SFDR is mandating the investment management industry and other product providers, it could be active or passive, interestingly, to then provide the underlying fundamentals around the ESG information within these benchmarks. And this is a challenge, given that, there's been the effort has been made through the EU Sustainable Finance Action Plan to look at climate-aligned benchmarks, to look at ESG disclosures of benchmarks, but there's not the same type of mandatory regulatory push behind this type of disclosure of information. And that means conundrums around clarity, consistency, and comparability of information definitely remain. And that is a challenge for the entire industry.
And do you think that for example, the principal adverse impact statements, are they sufficient to give people the information to make an informed decision? And presumably the cost of implementing this has got to be quite high for the asset management industry. And then is that going to get passed on ultimately to the end investor?
Well, that's a very interesting question. Again, we're talking now around 14 different categories that have to be disclosed. We had initially, I think, 32 or 33. There was a long debate about this. The latest information has just been released in February, and still it requires further ratification around what we then define as the type of indicators that everyone now needs to use. So there's, on the one hand, a bit of a conundrum still around what and how to define green. I think that's a challenge that has actually shifted from the investment management and the ratings industry towards now policymakers and regulators. And that's going to be interesting to see also how that plays out at the end for all of us involved. But clearly, it requires now an additional level of granularity when and where disclosures and hence reporting are concerned. And I can say that from our end, we are hiring, the industry is hiring at large in order to make sure, we have the relevant means and technology, I should say, so resources and technology in place to comply with the level of disclosure and the type of reports that are being required. And I think it will absolutely require more resources / budgets from the industry to be ultimately utilized in this way. When how these costs are currently charged against the funds versus then ultimately the end client is and remains a question and a conundrum. But I think the active management industry is just the one piece of the puzzle. Where I see the larger challenges is around passive investing. Because again, an ETF or an index-linked fund that then has to disclose the underlying fundamentals in and when how ESG, for instance, indices are concerned, how will you get to this level of information disclosure? It's not just a challenge at the side of the investment management or product provider. It's also a much bigger challenge for the wider investment value chain. And it remains to be seen how and where there will be a further drive and a mandate for further disclosures and the definitions around what is green from the regulatory perspective on the one hand, and clearly from the end client, the asset owner perspective on the other. And we shouldn't forget this entire industry has literally taken off, mainly based on the fact that the end user, the asset owner, has a clear expectation on what to see and how to define certain aspects around SRI, ESG, ethical investing or impact investing, whatever that might be alongside that trajectory. But it remains to be seen if they're also taking a much more active stance in challenging the type and levels of disclosures that we will see in future. And if they're willing to take some of the costs in turn, we will see.
Lauren, can I just bring you back in here, because your readers are wealth managers, they're IFAs, they're often the asset guardians, for whom this is very important. Their clients are asking them increasingly around ESG products. Are they prepared to pay a bit more? Are they prepared to have higher total expense ratios in order to have better ESF disclosures? What's the sort of mood music you're getting from your audiences?
Sure. I mean, charges are always an emotive topic within the asset management industry. But I think you only have to look at the data and realise that the demand for ESG products and sustainable products is huge. I think there was a Harrington study recently that found that since the end of 2019, 84% of all equity funds that experience inflows were into ESG specific products. So the demand is certainly there. And I think with SFDR, with, we saw the Dasgupta review, didn't we, earlier this year, that found a direct link between biodiversity and the need, and the economy. I think it's now at the forefront of investors' minds that this is not just a wouldn't it be nice, it's actually necessary in order to generate alpha and to sustain long-term returns. So, I think that's what active managers are paid for, to make these decisions. And certainly the onus should be on the asset management industry to make sure that they are aligned with, the reporting requirements and, ensuring that their portfolios are sustainable. So, I think in order to generate sustainable long-term returns, investors may have to pay a little bit more over the long term. But my view on it is that investors are relatively sanguine about that prospect.
Yeah. I have some thoughts on this. So I think we may be confusing a couple of things, and something I'd like to talk about is sort of the concept of labeling versus enabling, and I think we're seeing a lot of focus and discussion on labeling stuff, not just putting like actual labels on it, but also measuring things, coming up with metrics and ranking, companies and products and scoring. And I think it's all important, but what we often forget to do, I think, is to be clear on what all of this activity is actually supposed to enable. And I think that's certainly the case with ESG funds. So certainly there seems to be large demand for this kind of product. I think the demand is kind of predicated on an assumption, often sort of implicit, that these products are somehow going to make a better world. And I think often that's sort of a theory of change that isn't very sort of strong. And so I think there's sort of this risk of just kind of perpetuating this dynamic where we're just creating more and more ESG products because we're saying, well, obviously people want it because they're buying it, but we're never really asking exactly what are you looking for, exactly why are you in the market for these products? So like, what do you actually hope it will contribute? And back to James's point, I mean, is it more sort of a financial performance kind of thing? Because obviously a lot of people are saying, oh, ESG contributes to performance, so that's great. But other people are saying, no, but it's more about value. So I don't like the idea of investing in tobacco companies or oil companies. And yet other people are just like, well, I want my money to make a difference and to contribute to solutions. I don't think we're having that discussion, and I think it's also because we're not talking about it. So the regulations that we're now seeing are also not talking about it. I mean, the SFDR. It's good that the European Commission is obviously is proactive in this space, but I think SFDR is also a textbook example of sort of this focus on labeling over enabling, because if you look at the actual text, if you look at the history of where this came from, this regulation, it's not really clear what problem it's supposed to solve. And so I would say that any regulation that provides clarity on the problem it's trying to solve, also being clear that it's a widespread problem, so it's sort of sufficiently problematic that we actually need to create this regulation, and we need to get a whole industry to put time and money and effort into implementing it. It's all fine. I think we should have a higher standard though for that sort of thing, because I think SFDR is really just forcing us to do yet more labeling. Obviously, the whole discussion now is about Article 6, 8, and 9. Never is there any kind of discussion about what do those Article 6, 8, and 9 products actually contribute. There's an assumption that an Article 8 product is better than Article 6 because it promotes ESG factors. How does that make a better investment? It's promoting ESG factors. Does that make a better world? Does it make for better financial performance? I mean, it just depends, right? There could be Article 6 products that do it better than Article 8 products. So I think we should go back to this original discussion of, presumably we're all doing this because we want to enable something, contribute to something. So let's focus on that. Once we've sorted that out, then we can have the labels and the metrics and the rankings and the scores to figure out if we're actually doing that.
Yeah, I mean, I think on that, I'd agree that I've got a bit of probably disclosure or labeling fatigue, but I think this wave to me is a bit different in terms of it's so sort of systemic, and it's not just the ESG funds that have to start doing something. It's everyone. So I think if you can get that hygiene factor of we're getting sunlight in across the whole financial system, it's not just a spotlight here and there. I think that could have a big effect, because people don't like being caught holding the dirty stuff. They want to look better than their peers. So that could roll through the banks and the asset managers. And yeah, then as Harald said, I think it's, what does this disclosure tell you? I mean, it's there's a lot of scores out there based on just the fact that disclosure is done, but then does it tell you something useful? Does it tell you the F in TCFD, the financial bit? What's the financial implication of it? Does it affect your revenues, your asset values? That's where we're missing, I think, the picture is, we've got this information allegedly now, but there's almost too much of it. And does it, a lot of it actually tell us anything useful for what we're trying to do?
Can I just pick up a little bit on what you said there, James? I mean, there are some studies that have been done that show that a lot of ESG performance isn't actually down specifically to ESG factors. They're down to other factors in the market. So, for example, it could be driven by the size of companies. Larger companies tend to have better ESG disclosure. They tend to have lower volatility. They've done rather well over the last 10 years with very large tech companies particularly. Is there a risk that people are putting too much weight on ESG factors, or not really understanding how they fit within the mix of various factors that drive investment performance?
Yeah, I mean, I think that's the part of the thing about ESG integration is you've got to understand, what biases are you introducing, and how does the fact that a large company in the West, in a sector that's been engaged to death for the last 10 years on ESG will score much better than a small one in a low impact sector from Asia. So, you've got to understand how that might impact your portfolio construction and the benchmarks you're comparing it against. So absolutely, that's part of the picture. If you're integrating something, you have to understand what's in it. Otherwise, you might be, overlapping with your other drivers. So, I think that's where we're seeing, certainly our efforts are going back to, the underlying data and understanding what that tells us. And, our lead analysts know the companies that we rate, and that's what they're able to do, is to actually understand, well, in the context of what this company does and where they do it, is that material, rather than it just taking the number as 57 and therefore that's good or bad. And
Lauren, I'm just going to steer the conversation away a little bit here. Is there, I mean, certainly I get the impression, reading the newspapers, and maybe the newspapers are to blame for this, that if you look at ESG, 90% seems to be around E and 10% around the S and G. Have we gone too far looking at that one factor? Is there too much weight on that, at least in the media? If not, I'm sure if in the case of James and the people who are looking at rating and look at the sort of detailed criteria, that's different. But for the general public and also for the wealth and asset management community, is there too much focus on E, not enough on S and G?
That's a really interesting question. I think a couple of years ago, actually, the focus was very much on the G. I think that was, if you like, a nice segue for the asset management industry to start implementing ESG. Because in theory, I mean, again, I'm not an investment expert, but, in terms of governance, if a company has good corporate governance, then by proxy, it should generate good long-term returns. It's the idea of a sustainable investment. So I very much got the impression that all of the studies suggested that funds with a focus on G perform very well, which you would obviously expect. There was less data around in terms of the E and less so on the S. I think if we move forward, you're right, there has been a big shift towards the E in ESG. But again, as Harald and James have said, that is so subjective in itself. You mentioned the FANG stocks earlier, sort of really bolstering a lot of these ESG friendly portfolios. But actually, I think 3% of all global CO2 emissions come from the sort of modern computing sector. So it's all entirely subjective in itself. But I think, in terms of S, there is more work that needs to be done. I think we are in the process of doing it. And again, I think we are in the process of coming to understand and being able to quantify through data the fact that if you do focus on the social aspects of companies and their social considerations, then it will generate more sustainable returns. But you're absolutely right. For me, it seems as though it's gone G, E, and hopefully we'll have more focus on the S. But next, investors really need to look at the acronym, if you like, in aggregate and take it all into account.
And just following up on that a little bit, the Meghan Markle interview recently, is that going to put S back on the agenda? It's a very high profile thing over the last couple of weeks. We haven't been talking about gender diversity or even racial diversity to the same extent over the last year. Obviously, a year ago, we had the Black Lives Matter protests. And suddenly this is back on the agenda again. I also noticed we got an interesting question that's come through from Americana Intelligence, who talks about Black Lives Matter and gender equality as hugely powerful movements, which are linked to having impacts in terms of climate change, because they're the people potentially who are most affected by it. Do you think we're going to see a move back this year to S coming back onto the agenda a bit more?
I hope so. And, they're absolutely right. In terms of Black Lives Matter, I think since the murder of George Floyd in May, there was a huge sea change. For the first time on my LinkedIn, I was noticing that members of the asset management industry were openly discussing race, which is incredibly refreshing to see. I think arguably, there's a lot more that we need to do in terms of gender. I mean, I'm talking both sort of asset management industry, but in terms of individual companies that by proxy the fund managers invest in. Gender has been on the agenda for a while. People feel more comfortable discussing gender because everyone knows, everyone has either a wife or a sister or a partner. It's more complicated when we're looking at the S in terms of race, in terms of neurodiversity, in terms of socioeconomic diversity. But I think that now people feel more comfortable discussing it. And that is the real sea change that we need in order for companies to start looking at the S. And we need the data, actually. We need companies to start quantifying sort of the diversity that they have across their companies so that we can really start implementing that. And then by proxy, fund managers can hopefully make the right decision and focus more on the S in ESG.
Martina, can I bring you in? I don't know if you agree. I mean, if you went back 2 or 3 years, you couldn't move the talk about the gender pay gap. Obviously, reporting was delayed because of the pandemic last year. It seems to have gone off the agenda. Is it going to come back on the agenda in 2021?
Maybe not per se in 2021, focusing on gender pay gaps only. But I think definitely COVID combined with Black Lives Matters has put the S topics right back on top of the agenda. It's all about social resilience and the just transition. And it's very interesting because these topics have been following me through here, at least on both sides, ESG research and ratings and investment management for the last 12 months at least. And it comes at no surprise because there are elements here that are aiming to connect the E with the S. So the E plus S is the new domain. From ultimately the climate and green to the ecological to the just transition is a clear trajectory. And it might come at no surprise that for COP26, I'm now part of a working group here with the PRI. We are looking very closely at what the just transition implications, so that means E and S, will mean for our broader ambitions, in alignment with physical and transition risks, moving also beyond what has been classified as the financial risk dimension only, towards, dual materiality and implications that will also include the wider stakeholder picture. So, ultimately for this year, absolutely, the S topics back on the agenda. And that will also include policy and regulation. The social taxonomy, for instance, is the latest development coming out of the EU Commission's work, when and where we are back to standards and frameworks. And it will be interesting to see how this type of work can be quantified, given that this is the big challenge. Social topics more generally are less quantifiable, and there's a lot of qualitative information around them. But I think there's definitely an ambition being made to quantify it and build specific criteria and factors / KPIs on how that social dimension could look like. And that brings me back to the last discussion we just had. Something that attracted me to the asset manager I'm now working for is that we have a specific proprietary model scoring S and G, even weighting slightly the ambitions towards G as the baseline, as it was mentioned, and then S, which is closely interlinked with a lot of the governance indicators when we look, for instance, at human governance and human capital management in the broader context of how organizations are running the people and their skills that they have as the core assets within their portfolio, so to say, that we are literally weighing these S and G criteria by sector, but then at an aggregated level across sectors, slightly higher than the environmental baseline. So it means we are looking at 40 to 50% on average as an allocation towards S, 30 to 40 on average towards G, and somewhere 10 to 30 when and where E is concerned. And I think that is quite unusual, but also a good indicator that this is what we discussed earlier, that not one size fits all. And you need to make the case, the business and the investment management case, for really trying to providing a much broader view of the world than just what's been classified as climate risk mitigation and adaptation, which is clearly a prerequisite and one of the fundamentals and baselines, but not all, to understand this very ever increasingly complex picture of different layers of ESG information.
And I just pick up on that governance point, because we've had a question through, which is, should we be tying executive compensation to sustainability goals? Is the solution to getting companies to behave in a certain way to make their leaders accountable in a way that's going to be very meaningful for them personally, i.e. what's going to affect them in terms of financial incentives? Harald, I don't know if you've got any thoughts on, is this an effective way, or does it really have to be at the heart of their culture? I know you're interested in blended finance, and is it actually a sort of case that it's got to be driven by genuine culture, by a genuine desire to change, or can we actually get there by putting a bit more money into people's pockets, or taking it out of their pockets if they don't deliver the behaviour that we want? We don't have any CEOs on this course, so I think we're safe, aren't we? So.
A lot of questions there, and I saw another question here on the feed related to government policy or regulation. So actually, this is a nice challenge to see if I can come up with an answer that addresses all of these questions. So I mean, we should obviously be thinking about executive compensation, just generally speaking, right? So it's an area where often it seems there are perverse incentives for executives to focus on short-term performance and all that sort of thing. I think, so they're actually, I think people may be sort of over-analyzing this or over-engineering this. I suppose you could come up with specific examples of companies where you say, okay, there's some very clear sustainability related goals that we'd like the executive to focus on. So we're going to tie their targets or their compensation to this. I think generally speaking, though, it results in packages and arrangements that are just very complex and probably end up incenting executives to do the stuff we don't want them to do. And so Alex Edmonds at London Business School does quite a lot of thinking about executive compensation. Basically, his solution is basically, just make sure it's a long time horizon. So it needs to take a long time for executives to actually be able to get at their compensation, or at least a variable compensation. And then it needs to be structured in a way that it's sort of tied to high-level goals for success factors. And so then basically, if it's well-designed, executives should capture sort of all of the different elements of strategy and goals and stakeholders in their work. So I think it's probably not going to make a whole lot of sense to tie compensation specifically to sustainability goals. I do think so on blended finance. Obviously, that is a topic that's very dear to my heart. I think if we're talking about investors specifically, it's an area where they can really make a difference and make a contribution, because basically we have to recognize that in the world of impact investment, a lot of the projects and companies that we would like to fund, or that are bringing solutions to societal challenges, are very risky, are very early stage or sort of nascent technologies, and generally do not provide market rate returns yet. So blended finance is a way to get around that, where investors are working with governments or development banks to structure deals in a way that each party at the table has a specific sort of set of risk return requirements. You structure the investment in such a way that that it suits everyone, but everyone has package, so to speak. So happy to talk about blended finance in more detail, but it points also to the importance of government and especially public policy, the issues that we tend to talk about, in the world of ESG, also linked to the SDGs. So I think that's also something that isn't discussed nearly enough, that usually when we're talking about these problems, governments have a pretty big role, or should have a pretty big role, compared to the private markets and or the private sector. And I think climate change is a very good example. So most of if you ask climate scientists and engineers and economists and so forth, most would agree that we have a pretty good set of tools and instruments to deal with climate change, but it's mostly in sort of the court of the governments to put in place these instruments and to actually use these levers. And it's stuff like creating carbon taxes, for example, or making decisions about whether or not to use nuclear power more, or sort of industrial policies. And so that's an area where investors or the private sector can certainly help contribute, but the main responsibility, I would argue, is with governments. And so that's to address the question that I also saw on the feed. I think that's something we should be talking about much more in the world of ESG. What public policy would we actually like to see to address these problems, and what can we do to to contribute to getting this public policy in place?
So just to pick up on that a little bit, I'm going to bring Martina on this one. There's been quite a lot of I suppose change in academic thinking around the role of companies. So Michael Porter of Porter's Five Forces came up with this sort of concept of shared value initiative. You've got Northam and Kramer doing positive impact. A lot of the academic thinking is now moving towards the role of the company as creating a positive impact or positive externalities. How important is that? We just heard from Harald about really government's going to have to drive this. How important is the actual company's behaviour? And then I'd like to sort of pull James in to talk about how that sort of actually translates into improved things like improved credit performance and elements like that. So if I can just start with you, Martina.
Sure. I mean, in the context of all what's been said, and where we see even, the regulatory agenda here in Europe is taking us with NFRD, the equivalent, for the corporate disclosures, when we look at SFDR on the investment side and investment disclosures versus NFRD, non-financial disclosure directive, that actually looks at specifics when and where companies need to make sure they're disclosing the relevant information on ESG and diversity. All of these discussions are now pointing towards one way, and also invest managers including are driving this, that it is no longer just acceptable to invest in businesses for profits alone on the one hand, and for businesses to focus on profits only on the other. Doing well by doing good, that's obviously a well-used term and framework for all of this, but there are other discussions now that have risen to the fore, with the Business Roundtable, for instance, in the US, and many other initiatives by corporate governance frameworks. The debate around the purpose and the long-term value of the organization, that's also focusing capital on long-term, a dedicated initiative around this, are pointing all towards the one way, that there is an expectation for companies to actually fulfill their role as a stakeholder within the stakeholder value chain. And this is something that has been happening over the last 5 years in particular. We've seen studies also from Oxford, first of all, aligning corporate social performance and corporate financial performance. Again, that's maybe Harvard, and then Oxford following on from there, from actually the shift from the shareholder to the stakeholder performance picture, right? And all of this within the last 5, maybe a bit longer, 10 years, is again pointing towards the fact that we're now seeing the organization and the way it manages its stakeholders. And we touched on the human capital management expectations, and that's employees, but it's also the wider connotations around human rights and labor standards, and when and where, for instance, supply chains are concerned, the role of the organization in the community, increasingly rising, this question around COVID-19 context, and when and where these sort of social challenges under the remit of social resilience are managed. It's also bringing these other S and stakeholder topics for organizations back to the fore. And ultimately, again, we as an investor, we are looking for these good S criteria and fundamentals. And I think it's no longer just a debate for impact investors that have historically been focusing on social impacts and maybe SDG alignment and other type of metrics. Given that these lines are getting increasingly blurred, and given that there's now a trajectory towards dual materiality, as we highlighted, towards S and a social taxonomy to quantify these issues, and the generic interest from investors to better understand how to capture this information, there's also a clear expectation being set of the company in its role within society as well as within the investment value chain.
James, so do better companies have lower credit risks if they behave better?
Yeah, I mean, I think just picking up the previous bit about the rise of S, I mean, it's a dull process point, but yeah, yesterday I was in a rating committee, and every rating committee now has to include, did ES or G, drive our rating outcome, and if so, which one was it? It's also part of the discussion, and it's increasingly hard to split them up, and maybe we're falling into that labeling trap, Harald, but it's kind of like, well, is the fact that this is a consumer pressure and there's more sort of global concern around climate or plastics a social trend, or is it an environmental issue, or is it both? And is the failure to manage that a governance problem, and therefore it's all three? So that's part of the challenge, I think, is it is increasingly hard to put them in one bucket. I know certainly that there were a lot more S-driven actions due to COVID last year, but I think that's again where we've got to think about sort of events versus trends, and there's always going to be events that stimulate more interest, and that's that is a good thing. It puts the spotlight on issues that maybe have been lost, but we then have to see, well, what does that tell us about the resilience of the company or the quality of the management to deal with that, or have they got a flexible enough strategy to shift to a new modus operandi? And I think that's where there's the report came out this week about Climate Action 100, and there's huge uptick in terms of net zero strategies for several decades time. Only sort of a handful literally of those companies have a plan for the next 5 years. It's the first step on the road that's the hardest, and that's the one we look at for credit. It's what are you spending now? Where are you spending it? Is that going to put you in a good place? We've seen it in the auto sector. If those companies haven't been investing in new models, electrification, the battery supply chain, they need to do that a few years in advance. You can't suddenly magic up 10% of your vehicles being EVs overnight. So that's the quality we're looking at, is can the management come up with a good strategy, and then do we think they can deliver it?
And let me bring Lauren in here, because a lot of these changes for these companies are being driven, dare I say it, by a sort of generational shift in attitudes. So we know that younger generations are increasingly coming through. They have an increased weighting on the importance of ESG factors, but also the concept of the companies that they buy from doing good. And are we in a situation now where you've almost got this sort of double whammy of a young generation who are only going to invest in companies they think are doing good, and are only going to buy from companies they think are doing good? So you're getting this sort of magnified effect. And the reason I'm asking you this, Lauren, is obviously clearly you're miles younger than me. So do you think that this is the sort of these sort of key this key trend sort of comes to bear. And of course, it's going to keep going into the future. And for wealth managers, particularly, this massive generational transfer of wealth from the older generation have slightly different values to the younger generation. Surely this is going to transform, not just ESG investing, but the entire wealth and asset management industry too.
Absolutely, yeah. I think that asset management companies themselves have to practice what they preach. And I think by the end of last year, 30 of the largest global asset managers companies, with AUM of I think $9 trillion US, have all pledged to begin transitioning towards net zero, which is really encouraging. And I think this trend is only set to continue. I think it's one thing having ESG products or sustainable products sort of not falling into the labeling trap, but also, absolutely, companies need to be cognizant of what they're doing. And I think you're right, this generational wealth transfer is very much on the cards. It is going to happen over the next few years. And I think you're right, younger investors, or sort of, I was doing a panel the other day, sort of Gen Z now, it's not millennials anymore, it's Gen Z that we have to look at, because now the oldest Gen Z is 24, which is a bit mind-boggling. But no, absolutely, there is a far greater emphasis on that. But I also think that older investors too are becoming more and more cognizant of the need to invest sustainably. Not just from as I said earlier, a do-good perspective, but in order to generate sustainable long-term returns.
Well, I've just got one more question before we go out, and we got a number of different questions that are coming on the chat, and I'd like to open out to a wider audience. And this is for all of our panel here today. Last year was an exceptional year in terms of ESG performance, particularly in the equity sector. Already this year, there's been quite a sell-off in some sectors, such as clean energy. Is there a risk that with some of these sell-offs, even though they're relatively short-term at the moment, some of that momentum gets lost? As investors tend to take quite a short-termist view? I don't know if you see that as an issue, and if that's going to weigh on this long-term trend towards ESG investing. Don't know if anyone's got any thoughts.
I think you can always pick the statistics that prove you've performed well or not, depending on what time period you pick and what benchmark you pick. But we have this discussion as well with whether it's GDP or whatever. If it went down last year and then there's growth this year, but that's only growth to recover some of what we lost last year. So if you look at fossil fuel stocks, they had a terrible year last year. A lot of them had negative cash flow, and not just the majors. The bottom of the pyramid went through their second round of bankruptcies. So yes, they can only be in a better place than last year, but does that mean they're a good long-term bet? So I think it's a bit simplistic just to look at the kind of movement of stock prices over a short-term period.
Great. Well, if we don't have any further comments on that, then I think let's go and have a look at the questions that have been sent through to us by the attendees here. And there's some very sort of interesting issues which we haven't yet covered. Interesting one from Aaron Farrow, who I believe is who asked, with greenwashing rife, do ESG products present a misselling risk?
Yes. I think, well, I'm happy to take this. I think actually it's interesting. People on this session may have noticed, but there was a recent example of a German bank, a DECA bank, who was actually sued for misselling, and this was based on an impact product. So I think it's not so much my personal opinion. I think it's now a fact that like with any investment product, if you're not doing what it says on the tin, then it presents a misselling risk. And it'll be interesting to see if we're going to have more sort of lawsuits like this. I think, though, what's much more interesting to talk about is rather than greenwashing is this concept of green wishing or green wish, which I didn't actually come up with that. There was, I think, Duncan Austin wrote an essay a year or two ago. I think he coined the term, but that I think is a more interesting concept because it is it basically describes what is happening now in many ways in the world of ESG and impact, because even where there's sort of genuine intent, so in other words, there isn't greenwashing, even if you have sort of a genuine story about what you're trying to achieve and trying to live up to your commitments and all that, then still, I think in a lot of cases, there's green wishing, in the sense that we wish, or we sort of hope, that these investment strategies bring us real world outcomes and help, create a better world and all those good things. But actually, in reality, we may be proven wrong. And so I think that's why, also going back to what I said at the beginning, I think there should just be much more debate about all of these strategies and approaches, and should be more interaction, I think, also with academics and people who have specific expertise on topics like climate or hunger or poverty or whatever it may be, just to make sure that we are actually coming up with tools and instruments and investment approaches that actually do help. And then I think if we focus on this concept of green wishing, then that will really allow us to make progress. I think if we focus on greenwashing, it's just going to result in more sort of finger pointing that we already have quite enough of, I think.
I mean, is there, just on that topic, I mean, is there a case that there are certain action groups who will never be satisfied with the with the ESG disclosures, with the investment process that people are applying? Martina, I don't know if you've got any thoughts on that. Is there always going to be an element that's going to be unhappy out there?
Well, that's the nature of things, right? I mean, one size does not fit all, and that's for sure. And doing well by doing good is also a way of interpretation of what the ultimate outcomes are and should be, and they might look fundamentally different for the type of investor or use cases, as we say. So clearly, we are working very much with NGOs and dialogue, and again, dialogue across the stakeholder value chain that will include academics and include NGOs and others, can help to jointly address and tackle some of the most prevailing issues. And I think maybe that is a key, not to necessarily meet everyone's needs and demands, but to provide more of this clarity, consistency, and comparability that I highlighted earlier. I am a part-time academic. I teach at University of Zurich and Henley Business School. I've just currently finished, the handbook on biodiversity, Routledge Guide, what will actually enable investment decision makers as well as policy makers and regulators to get a deeper insight into some of these topics that are classified as the ecological transition, preparing for the next edition, looking beyond the E, as I highlighted. That's a trajectory that's following me and the industry through, not just here from getting more clarity and information, as we said, but also ultimately then to work with other stakeholder groups to tackle jointly when and where there is need for clarification. And I think that is one way going forward, and an increasingly more important way to also bring in the sovereigns, for instance, into the engagement debates. PRI has launched a dedicated initiative, and last year there was a report as well that came out on sovereign engagement. And I think Harald has just mentioned how important it is in the global context, in the way of actually addressing some of the ESG issues at scope and scale, to involve also policymakers, decision makers at a sovereign level, especially when and where also emerging markets are concerned. And I strongly believe that through this collaborative engagement effort, again, across different stakeholder groups, we are more and better placed to actually tackle the issues.
Martina, if I can just go back on one point you mentioned, because one of our questions is, how can asset managers take biodiversity into consideration when calculating impact metrics? Which, given what you've just said, means that you're probably the most appropriate person to answer this specific question, if you've just written a handbook on it.
Sure. I mean, I can just point to the handbook, of course. I mean, in our specific chapter, we've mapped more than 30 different biodiversity frameworks, classifications and metrics that is within these type of frameworks as well, on top of everything else. So clearly, what is coming out of this is that there is not one size fits all. Again, biodiversity is a largely and a loosely, defined term. You could look at natural capital implications. You could look at specific sector exposures. May they be agriculture, may they be forestry, may they be else. You could look at it from the type of level of exposures when and where externalities of companies are concerned versus the wider ramifications around ecosystem challenges and ultimately collapse. You could look at the implications for species. IPBES, just to highlight this, did a fantastic report together with the UN that came out in 2019 that highlighted the sheer crisis, the extinction crisis we are now facing. And ultimately, I'm also pointing the person here to a working group that's also flagged and highlighted in the book, the TNFD. Increasingly, we are seeing these efforts that have been successfully made to assess climate risk and their impacts in financial risks, for instance, as James highlighted, but also beyond. And there's this obviously TCFD working group that specifically looked at the financial implications and risks related to climate. TNFD, which is coming out this May, is the group that will aim to make the same effort around nature-related risks and opportunities. One thing to mention, which is something interesting we came across as well as part of our research, is that the CISL, the Cambridge Institute for Sustainability Leadership, has just recently issued a report that looks beyond the traditional physical and transition risks that are very often highlighted in the TCFD and now in the TNFD context. And these are the issues linked to liabilities and litigation. So the whole context now of making ecocide, for instance, a legal risk, and the whole ramification of when and where, for instance, controversies linked to the pesticides debate and chemicals in use, which in turn also contribute to species extinction and loss, that these sort of factors are all interconnected and maybe also need to be addressed beyond what we have classified as physical and transition risks, is something that's also coming up and very, very now on top of the agenda and mind. And that's also in turn, of course, encouraging companies, right, managing their risks to look more closer at ESG, because we shouldn't flatter ourselves. It's literally investor demand, regulation, and litigation, which will probably change and drive this agenda for the better in the long term.
Great, thank you very much. I think we've, unless we've got any other questions, I just want to sort of finish off on just one question for each of you. So the title of our event here today was, is the asset management industry a leader or a laggard in the ESG revolution? So my question to each of you is, leader or laggard? Martina.
Well, I'm biased, I have to say leader, but I think at the end it depends on the type of asset manager, his or her type of ambition and use case. And ultimately it depends on the ambitions, the joint and collaborative ambitions of this stakeholder and investment value chain. And it's important that we have all these representatives across the board today, also on this call.
Fabulous. Lauren, leader or laggard?
Based on a vast majority of the news articles that myself and the team have been writing, certainly over the last year, I would have to say leader. Obviously not a reason to rest on our laurels, but no, I certainly think that some incredible steps are being taken.
James?
Well, I think it's a bit of both. I mean, I think there's been a lot of incrementalism, and that is not added up to obviously where we need to be, as all the metrics tell us. And I think, if you look at something like technology, there's great things that we're doing in terms of using technology for traceability and, tracking impact and demonstrating, breaches and monitoring. But then equally, you can have maybe a AI-driven ESG fund that is mis-selling to the market. So, I mean, I think we need to be very careful in terms of getting ahead of ourselves.
And Harald, last word goes to you, leader or laggard?
Yeah, so I don't think the investment industry is a monolithic thing, right? So there are leaders, there are laggards. I think maybe just to add to that, I think what we might see is a switch, in the sense that some of the groups, companies that are considered to be laggards today may